What is going on, traders? Welcome back to the Traveling Trader. The stock market is flirting with all-time highs again. We saw record earnings with some of the mega cap companies. However, there's one indicator that has been a precursor to corrections within the last 3 years, and I'm watching that like a hawk right now. I'll be discussing this with you, why the market could see a correction within the next 2 to 3 months. But more importantly, I don't bring this to you to fearmonger. This is for informational purposes so that you can act accordingly. I just want to preface this by saying I do think that the bullishness will continue in 2021 regardless of any short-term corrections there is in the market. And then, as always, I'll be giving you an update on current plays and then show you what stocks that I'm looking at considering the current market landscape. But before I get into it, welcome back to the Traveling Trader, your source for no BS, concise, regular market updates. If you get anything out of this video, leave it a big fat thumbs up just like this. Leave it in the comment section below. Let me know what you think in terms of a market correction coming up in the next 2 to 3 months and what stocks you are looking at currently. I always love hearing from you guys. I try to respond to each and every comment. Let us get right into it. So I was looking at this article from CNBC, and there was a very interesting indicator that was pointed out by DTIG's Julian Emmanuel. Now, he said, and I didn't know this, there are a lot of indicators that I use to try to determine whether we're on the verge of a correction or not. But he mentions that the S&P 500, the NASDAQ, and the VIX, the CBOE Volatility Index, when all three of those are rising at the same time, that is usually a recipe, I don't want to say a recipe for disaster. That is usually a recipe for a potential correction. Now, a correction, as you know or may not know, is a drawdown of 10% or more, but less than 20%, because anything greater than 20% and you start getting into that bear market territory. So I pulled up all three on this chart here, trying to corroborate it for myself. On the left, we have the NASDAQ. In the middle, the S&P 500. On the right, the Volatility Index, or the VIX. Now, going back to August 2020, all three of them rose at the same time. As a matter of fact, the NASDAQ was up 9 point something percent. The S&P was up 7%. It was a monster month last year, August 2020, if you guys remember. And the VIX was up almost 8%. So all three of them rose at the same time. So what happened thereafter? Well, September 2020 is when the NASDAQ officially hit correction territory. Now, the NASDAQ was the only index to officially hit that 10% or greater mark. The S&P 500 missed it by fractions of a percentage point. Now, I want you guys to keep something in perspective. And the reason why we don't panic here, what happened in that month? Did we stop investing? No, as a matter of fact, we invested heavier, meaning we used a weighted dollar cost averaging model. So if you are contributing a certain fixed amount to the markets every month or every 2 weeks, according to your paycheck schedule, let's just say, well, when you do see corrections like this, if you do have added cash, you have cash on the side, you have cash sitting in a savings account, which is gaining nothing. You see the NASDAQ get to the 100-day moving average, down 10%. Well, at that point, you then weight your buy-in a lot heavier. As you can see here from September, we bought Facebook, Amazon, Apple. No need to reinvent the wheel. You could stick to blue chips here, and this is a perfect opportunity to rotate from some of these overweight risky stocks. You might have bought stocks based on YouTube videos and went a little bit heavier on them, such as GNOG, QuantumScape, whatever the stock du jour was a few months ago. You can use this as an opportunity to rotate out of those stocks into more blue chip stocks that are heavily discounted. Apple at a 25% discount, Amazon at a 20% discount, Facebook at a 20% discount. These are stocks that you cannot pass up, especially if you're building a long-term portfolio. So with that said, have we met the requirements of the NASDAQ, VIX, and S&P 500 all raising at the same time? Yes. As a matter of fact, the month of July, the NASDAQ was up 2.7%, the S&P 500 was up 2.25%, and the VIX was up 15%. So all three of them rising at the same time. The S&P 500 is also flashing overbought on the weekly RSI, and it has been usually a precursor to at least a minor drawdown, if not a correction. Now, I've talked about this before, but throw in the fact that August and September are two of the 3 worst months in the market. From 1950 to 2020, these 2 months are 2 of the most losing months in the market, especially in post-election years, which we are in right now in 2021. Also, it looks like investors are flocking to bonds even at these ridiculously low rates. The bond rate continues to drop. Currently, the 10-year bond trades at 1.16%. That's over 10 years. Now, for the bond newbies, when the rates drop, that means people are flocking into bonds and buying them up, because the rates rise when folks start selling their bonds and the bond market starts raising the rates in order to appear more attractive to those who are leaving bonds, right? So when you do see the bonds drop, that usually means that folks are flocking into the bond market. And if they're flocking into the bond market, that means they are more risk off and are starting to take that cash from the stock market and place it in the bond market. Remember, the bond market is actually way bigger than the stock market. So how to trade this going forward? Well, there are a few things to consider here. Long-term stockholders might not be willing to sell their stock because you then incur a much larger tax burden if you've held the stock for less than a year. So if you've held the stock for less than a year, then your gains are subject to your regular income tax rate versus a much lesser rate if you hold the stocks for longer than a year. So trimming might not be an option for some of the long-term holders. Now, for short-term traders, they might not care, and they would want to take profits regardless of the tax burden that they incur. Now, if you're a fan of this channel, you know that I'm a huge proponent of staying invested in the market in one way or another. However, if you are investing now, just know that you are doing so at the top of the market, at the market high, with all of these indicators showing potentially choppy waters ahead. So for folks in that situation, you might want to think about keeping some cash on the side for if and when your favorite blue chip stock actually goes on sale and hits a major support level. And by the way, things don't have to fall into a correction or correction territory for you to take advantage of them. Square is a perfect example. Square was sitting at the 200-day moving average just as far back as May. We were not in an official correction. At that time, it killed earnings. It was sitting at the 200-day moving average. It was at the bottom of this parallel channel here, which was major support, and we ended up buying Square. Yesterday, it rocketed to $275. We made 32% in just a couple of short months. AMD was the exact same way back in May, sitting at the 300-day moving average, now cracking the $110 mark. This is a major blue chip with a significant acquisition potentially on the way, up 45% on AMD just from buying the dip, and we were not in an official correction at that time. Same thing as the QQQ, which is the ETF that tracks the NASDAQ. Just look back historically, anytime this thing was at a major moving average, whether the 100, 200, 300-day moving average, if you just kept disproportionately investing in the SPY or in QQQ at these major moving averages along the way, you'd be a rich person right now. So all that is to say, you don't need to try and time the market for an actual correction. By the time a correction happens, you might already be so far up that the point at which you drop is actually higher than the point at which you were thinking of investing in the first place. That is why I'm a big fan of disproportionately investing in blue chips at major moving average, regardless of whether we are in a correction or not. Another thing you could do is sell calls against your shares if you don't want to trim your shares. So Square or AMD, which are at all-time highs, you could sell calls against those shares. And if the share price never hits your strike price, you get to keep the money that you sold those calls for. If you get assigned, then you will have to give up your shares, but you're giving up your shares for massive profits. You can buy protective put options. You could buy inverse ETFs. You could buy puts on the SPY or the QQQ. Obviously, you'll want to size accordingly. You don't want these to be a main position, but you want to size them relative to a hedged position, which is usually 1 to 5% of your total portfolio. And just as an example of quality and blue chip stocks that we bought on the dip, again, not even going back to a correction, we bought Thermo Fisher, ticker symbol TMO, back in May. That's up 20%. UMC, we bought it also back in May. That is up 21% since buying the dip. We bought Nike, that was back in, I believe that was in May or March, up 31% at all-time highs. As I mentioned earlier, Square we bought on the dip. So a lot of people think that all we do is options, because I always talk about options. The reason I do is because options give you the ability to trade every direction in the market. So when there isn't a buy the dip situation, you can actually trade options and still make money in the market while waiting on stocks that you want to actually invest in. And if you want access to all of our trades, including the buy the dip ones, the options, link is in the description below. Would love to have you guys. So what stocks am I currently looking at? Amazon is a clear no-brainer here, sitting at the 100-day moving average. I'm willing to buy Amazon at a 12% discount even before a correction happens. And if we do see a correction that takes us back down to the 3K level, I will disproportionately invest in Amazon even more. Stocks like AMD and Square, in my view, you'll want to hold off in this current market landscape because these are at all-time highs hitting resistance. In my view, you could still slowly dollar cost average for the very long term on hospitality stocks. We didn't even talk about the Delta variant as being one of the reasons why, in accordance with all of the other things that I talked about, why August and September could be slow months, especially if we do see some form of restrictions depending on the jurisdiction. And if we do see a correction, I'm obviously looking at the QQQ and the SPY. I want to pick them up at the major moving averages, the 100-day, the 200-day major moving average. But yeah, if you're just entering the market in now, it's hard to find value here at such toppy levels. Anyway, traders, that is it for this video. If you get anything out of this video, leave it a big fat thumbs up just like this. Let me know in the comment section below what you think the prospects are for a correction within the next couple of months. Subscribe to the trading group below if you want access to all of our stocks, options, crypto trades, etc. Subscribe to the channel, hit that notification bell. Stay safe out there, traders. Peace.